Hi guys, welcome to Invest Visual. Today we're looking at Zeta Global, ticker is ZETA, market cap of 4 billion and enterprise value of 3.7 billion. So Zeta is a tech company. They sell software, and in this case they sell software for marketing teams. It does many different things, which we're going to look at in today's video. We're going to walk through what the company does. We're going to look at some of the risks, and we're going to also look at the valuation of the company to see if there's a potential opportunity there. The company shares have traded sideways over the last few years, but overall the company has been growing. Its revenue's been growing, free cash flow, EBITDA. The company's also been doing M&A almost every single year. Also just to note that at the moment the company shares are trading around $17 a share, so it's around, market cap is around 4 billion. So Zeta sell marketing software targeting mostly B2C, so brands. They have 572 clients, and they compete with Salesforce and Adobe's marketing platforms, also Oracle. They're expected to hit 1.3 billion in sales this year, and back in 2020 they had a revenue of 368 million. So over the last 5 years, their sales have 3.5x, which is very rapid, huge double-digit growth. And one of the key differentiations with Zeta's platform is that it has proprietary data on 245 million US consumers who've opted in. So if you've ever opted into a news or marketing from a brand that you've signed up to, or you get emails from them, your data points go into one of their platforms which they can track, and they have multiple different data points for each consumer, and they help the marketing teams understand who their consumer is, helps them target them better, helps them understand the demographics, who's most likely to buy one of their products or services, who's most likely to be in the market right now based on what they've looked at recently. So it's a very good platform, and it uses that data and AI for superior targeting of customers, and it utilizes AI to analyze these customer signals. They also recently announced Athena AI, which is, because the platform is quite large, it does a lot of different things. The AI is meant to help you with utilizing the platform properly and going to market quicker. One of the things management talks about with their software is that this platform is very high ROI for marketing, and it reduces customer acquisition cost, which is a great thing for marketing campaigns. If you're trying to reduce or if you're trying to get the most bang for your buck in your marketing campaign, having a software solution or services like what Zeta provide is very important. And this is why they've been growing their market share and been growing over the last recent years. But in terms of a forward trading basis, in terms of valuation, PE of 19x, EV to EBITDA of 11.5x. That may seem like it's a fair valuation, but you've got to remember this is a company that is expected to grow rapidly, and it hasn't really reached full scale yet. They're still growing, and they're not even GAAP profitable, so that's on a forward basis. But on a GAAP basis, they're not actually profitable yet, and that's largely because of stock-based compensation. But over the next few years, their free cash flow, they are free cash flow positive, and they have been for some time, but they're expected to more than double their free cash flow over the next 3 years. So we're also going to look at those targets from management. And the sell side have got a target price of $28 a share, which is roughly 64% upside based on to the mean target price based on where the shares are trading right now. So Zeta sees the marketplace as quite fragmented with different platforms. So you have data management, which is data on your consumers. And some of this data is from opt-in cookies on websites. And Zeta's platform, they have it from a number of different sources from companies they've acquired over the years. They also do marketing. So one thing they do is they embed the data that they're getting on their consumers. They're analyzing that data, and then helping the companies with a marketing cloud to go and create campaigns and distribute for their different channels, like their emails, their own website. You've also got engagement, so generating new customers and paying for advertising space through paid channels, display, connected TV, social media. And so what Zeta does, it consolidates all these three platforms. So it's saying that these are the different providers in the space. They're probably most likely competing with Sales and Adobe and Oracle's marketing platforms and their data platforms. And Zeta's consolidating all three into one solution. So it's quite a big platform, and it's quite data heavy. And that's why they've been winning market share, because it's made it easier for the client, a CMO, a chief marketing officer, or a marketing team's ability to use this platform and not have different vendors, not using Microsoft for data and then use HubSpot for your marketing. It embeds all this data into one place and all these solutions into one place. So it's quite a large platform, and that's why they've released Athena AI to help the user use the platform more effectively. But this is the reason why they've been winning more market share. And they've also got these different data sources. Some of these they've acquired over the years, like Live Intent, I think they acquired last year. They're getting data from so many different sources, and they're using it to analyze customer behavior. And that helps marketing teams, it helps them understand like who's in the market for one of their products, who's most likely to buy, where are they located, what are the different demographics that we have exposure to, how should we message them, like what sort of message should we use in our marketing? And so they take different sources and they kind of identify customer signals. And this is kind of the key USB with Zeta, or one of the key USBs, is that it has really good data and it embeds this with really good technology to make it easier to create marketing campaigns and specifically target consumers. And Zeta is named as a leader in the space from Forrester Wave. So it's kind of like Gartner, where it reviews companies, it talks to their customers and it reviews their offerings. And so you can see in 2020 they were one of the leaders in the space, and now they are the kind of the leader in the space with the strongest strategy and the best current offering for clients. And these are some of the highlights from clients. This is the company's last year's revenue by vertical. So you can see you've got a large exposure to consumer brands and retail, insurance, telecom, financial services, political candidates, services, education, travel and hospitality, tech and media, healthcare, automotive, and you also have some smaller contributors as well. But you can see a large exposure to consumer or the economy. So you have consumer, but you also have automotive, and you also have travel and hospitality. So these three specifically are also sensitive to the economy in terms of marketing spend. Also last year, 7 of the top 10 verticals grew greater than 20%, which is a real positive. And this is from the most recent earnings call, where the CEO is talking about the fact that they're winning larger contracts, and it's the larger clients. So clients that spend between $100,000 and $1 million per year with Zeta, they're giving them larger contracts. So the bigger clients are signing larger contracts, and that's giving them confidence in communicating guidance to the market. It's giving them more visibility in our forward numbers than they've had in the past. And then also in terms of RFPs, which are requests for proposals, where a potential client will ask you a lot about your products and your services before they sign a service agreement, about price and compliance. They're seeing more RFPs than they ever have, and they're seeing bigger RFPs as well, which is another positive factor that we're seeing in the earnings calls. And then also, this is from just from the internet. It's only based on 75 users of the platform. They have quite a high rating of 4.6 out of 5. And it suggests that what management are saying about companies having a lower acquisition cost for their customers, higher ROI, and better efficiency in marketing, that's what they're getting from the platform, because more and more customers are signing up and customers are having a positive experience. The company haven't been profitable just yet on terms of net income or GAAP EPS. Large portion of that, as you can see, is from their stock-based compensation here, but management have said they expect that to lower over time and decrease, and also depreciation and amortization, 50 million a year. So these are factors that you add back these numbers to net income. So on a real basis, the company actually has been generating positive free cash flow, but on a GAAP basis, because of stock-based comp mostly, they are not yet profitable yet. But that's expected to change over the next few years. So if you reconcile these figures on an adjusted EBITDA basis, they are profitable, and on a free cash flow basis, they're also profitable. So management have communicated to the street these forward targets for 2028. So revenue, you can see across all these figures, they have been growing: sales, EBITDA, and free cash flow. And they're expected for this year to do 1.3 billion. And in 2028, they're expected to grow to 2.1 billion in sales. Adjusted EBITDA is expected to grow to a 25% margin, over 500 million in adjusted EBITDA. And then free cash flow, they're already free cash flow positive, but you can see it's been very small. They're only just scaling up. But the expectation is this year they're expected to do 160, and in 2028 they're expected to do over $340 million in free cash flow. And I believe this doesn't factor in the Marigold acquisition as well. So these figures could actually be higher in these years. And so the positive of that is, they are growing. The expectation is the market does have some confidence that they're going to reach these targets, and it's discounted these expectations back. But a negative is that because management has communicated these targets, if they have a down quarter, or they potentially implicate to the market through a bad quarter that they're going to miss their 2028 targets, that is a real negative for this sort of investment. And that's where the risk is high, because you'll have a very aggressive sell-off, because there'll be a sentiment shift, because management have given very long-term guidance. So while dilution is an issue, it is expected to come down. But one thing I would say is that for the Marigold acquisition, they're going to be funding that acquisition partly with some equity dilution in Class A shares. So I don't think that's factored into these numbers. So I'd expect this to be a bit higher. Also, the performance stock units, this depends on the share price. So if the shares trade higher, the amount of performance stock units that get unlocked or get awarded to the CEO and to the executive team, or to C-suite executives, will be higher. Overall, management have communicated that they expect stock-based compensation to lower over time, and they have been doing some buybacks, which is surprising because their free cash flow, they've only just scaled up to free cash flow. They're still a scaling company. You don't usually see small software companies that are just scaling. use the money for buyback. So that, for my preferences, I would rather them not do that. So you can see here, performance stock units are being paid out at 0 to 200% based on the last 20 trading days of each fiscal quarter from 2024 to 2028. They will get paid out, 100% based on over $12 or $13 a share. If they reach $22.66 a share, they get double the payout. So I think the CEO has 1.5 million in performance stock units that I think they're vested over 3 years. If they do get closer to this price point, or they trade over it for more than 20 days at the end of the quarter, the CEO will get 3 million units. So it's going to be bigger dilution. So I just wanted to have a look at a valuation metric. This is the market cap based on the next 12 months sales, so the next 4 quarters. And you can see that from Adobe and Salesforce, who are scaled larger players in the industry, that means they do have more market share, they do have more variation, they have more diversification in their sales verticals and the solutions that they provide, especially Adobe. But overall, they are trading at a discount, Zeta, to the bigger incumbent players. And the reason I haven't used EV to EBITDA is because the company haven't really reached proper scale yet. They're still scaling up and they're growing faster. So I don't think it would be fair to look at price to earnings or free cash flow or EV to EBITDA. So I'm just looking at price relative to sales, and they are still priced at a discount relative to these bigger incumbent players that the market is placing a bigger weight on. So this could be a positive indication for the valuation for investors. So just some pros and cons before we go into valuation. Zeta's platform is winning clients. Contracts are growing. They've got double-digit growth year over year. I would say their moat is probably the platform that has proprietary data on this US consumers that doesn't depend on cookie data. It depends on opt-in, and they have a number of different partners or acquisitions they've made over the years that give them this good quality data that they can use to analyze customer signals, and that's why clients are using them. It's also omni-channel distribution, so you can distribute through text message, through email, paid advertising, through streaming, or through different programs, and that allows them to never leave the platform. You can do it all in one space, and that is a positive for the marketing teams that use this platform. It means that they don't have to use different vendors, they can just use one platform. They're also free cash flow positive, which is great, given they have communicated these long-term targets, which means to a degree management team are positive on the company's long-term growth and are comfortable giving visibility 3 years out. Also, the directors and executives own a combined 3.1% in the Class A shares, and also the CEO, he owns Class A shares. I think he owns 1%, but overall, because of his Class B shares, which he has a lot of, he owns more than 10% of the company. So there's great alignment where you have the co-founder, and who is the CEO still, has a large ownership in the company. So that aligns with outside investors, and it's always a great to see with software companies. But the biggest con I feel is stock-based compensation, which is diluting future EPS. Also the Marigold acquisition, I think that could have been funded with just debt and cash only. So that's going to, 100 million of that is coming through equity raising. So dilution of 2.4 or 2.5%, depending on where the share price is. And I don't think that was needed because the company has been doing buybacks over the most recent years. So over the last year, 70 to 80% of the company's free cash flow is going towards buybacks. They could have just kept that money on their balance sheet and used it for the Marigold acquisition. There's no point buying back stock if you're just going to dilute shareholders later on. Also, the market now expects you to hit these 2028 targets. So if Zeta underperforms in a quarter or suggests that they're going to miss their 28 targets, because the valuation is, it has some expectation in it at $4 billion. If they actually do miss the targets, you could easily see the shares fall 50% on a change in sentiment, because they have already communicated this to the street. And also 20% of the B2B revenue is consumer exposed. It's actually more than 22%, like I said, because that's from retail and brands, but also you have automotive, travel and hospitality that are economically sensitive. So a marketing team, if they see a recession, they may reduce their marketing budget by 50% because consumers are no longer purchasing. No matter how well you market towards them, the marketing budget for next year is going to be less, which means that Zeta's revenue, while marketing teams may keep Zeta's solutions and services, they may use them a bit less. So it could impact revenue in terms of how much marketing spend they're doing with Zeta every year. So that is one of the negatives, that they are cyclically exposed to the economy. So let's have a quick look at valuation to see what Zeta could be worth. So this is a DCF tool that I built to simplify the DCF process. It's a 5-year DCF instead of a 10-year, because I think with a growth company or with many companies, unless you have very good visibility on the company's free cash flows, building even a 5-year DCF is difficult. A 10-year DCF I just think is impossible unless the company has got free cash flows that are so easy to predict. It's almost like a bond. So the share count, they have roughly 250 or 240 million shares, but the fully diluted share count for Zeta is 250 something million, considering the equity raise for the Marigold acquisition, and also potential dilution over the next 2 years for stock-based compensation, I'm going to use a share count of 260 million. Current share price is $17 a share. Net debt, I'm going to use zero. Their net debt is actually negative 170 million, but I'm just going to use zero just to simplify the process. EV to EBITDA, I'm going to use 20 times, suggesting that the company is going to be, in 5 years' time, it's still going to be growing and the market's going to be paying a strong multiple on it. Discount rate of 9% and perpetual growth rate of 3%. And then for the earnings values, I'm going to put projections for the next 3 years. I'm going to put these roughly in line with what management is saying. So this is going to be for 2026, 2027, and for 2028. So I'm going to put 300. And then for the third year, where you're meant to have adjusted EBITDA of 525, I'm going to use 450, just to be a bit conservative. And also that's adjusted EBITDA, so it's a bit more of an inflated figure. And then for free cash flow, I believe for this year, 160, maybe next year it's going to be, let's just say 200. We'll say 260, and then 340. And again, these figures for 340 for free cash flow for 2020, which is what management's target is, they want to be above that. But I believe that doesn't factor in the Marigold acquisition, which means that free cash flow could actually be higher. So I think this is not too crazy of assumptions for these free cash flow numbers and EBITDA numbers. Then the growth rate for the remaining years, I'm actually going to put 15% growth rate for 2029 and 2030. So still saying for a 20 times multiple, you're still growing in the mid-teens range. So that's given us an intrinsic value of $29 per share, which is roughly 72% upside to the current price. And that's based on an equity value of 7.6 billion. So the way this is calculating it is it's taking these free cash flows. So if we go down here, you've got free cash flows for each of the years. You're discounting them back by 9% for each year. You're adding that figure up, which is giving you 1.2 billion, which is this figure here. But you also need to work out the company's terminal value. So what the company's value is going to be worth at the end of the 5 years to buy the entire company. So we're using two methods here. We're using the exit multiple, EV to EBITDA, and we're using the perpetual growth value. So this takes EBITDA for the 5th year, multiplies it by 20, which is $12 billion. You discount it back by 9% for 5 years, and that gives you a value of 7.7 billion. But then we also want to consider the perpetual growth value method as well. So free cash flow for the 5th year, we're putting a 3% perpetual growth rate on it, which gives us a value of 7.7. And then we discount it back by 9% for the 5 years, which gives us 5 billion. And then we take the middle number of these two figures, which is 6.3 billion. And then we add that to our present value of free cash flows as well. That gives us 7.6 billion in enterprise value. Obviously, net debt, we're leaving it at zero, so there's no adjustment there. And that's how we're getting to $7.6 billion. And I think that's a relatively, I think that's kind of in line with what management are expecting and what the street is expecting. But it also, if you go down here, based on the sensitivity table, what the intrinsic value per share could be based on different assumptions. And the two variables are the changing in perpetual growth rate and the difference in exit multiple for EV to EBITDA. So you can see here 29 is what we've put into our model. That's the midpoint. And then it's just saying, well, if it's closer to 16 or 17 times EV to EBITDA on a 1 to 2 times or 2.5 times perpetual growth rate, it's in the mid-20s. And then in a really positive scenario where you're having 4 to 5% growth and a 20 to 23 times EV to EBITDA multiple, you're in the 30s, so the low to mid 30s. And so this is quite a promising result for these assumptions. But if we wanted to be more conservative and say, okay, well, actually, let's build a more conservative case where the exit multiple in 5 years is going to be 15 because the growth is going to be slower. That growth is going to be 8%. Maybe they're growing 8% in 2029 and 2028. And the perpetual growth value, let's just say that's 2%. To reflect a kind of slower growth rate after the 5 years. We go down and it's saying, okay, well, actually, based on these assumptions now, we're getting a $5.6 billion valuation. Based on a share count of 260 million, we're getting just under $22 a share, which is 27% upside, which is still actually quite margin of safety if this is an accurate forecast. And then we go down and we can see, okay, well, it's ranging from 11 times multiple based on a 0.5 perpetual growth rate to 26 or 27 for high teens, 4%. And I think this is actually quite conservative. So I do believe that the company is probably undervalued. And this is just based on these assumptions. Obviously, the key risk with this business is if they miss these growth rates for 2028, the market will take a very negative view on the company. So for me, I've put Zeta onto my watch list and I'll probably look to open a position, maybe if it goes back to the mid-teens. So I hope this video helped you understand the investment risks with Zeta, helps you understand the valuation and also the fundamentals of the company. Always do your own research before investing in individual stocks. Please subscribe for more videos like this, and I'll see you guys in the next video.